Good evening, everyone. Lot of excitement happening in foreign exchange markets. Rupee has suddenly weakened from 85.50 to 87.50 in a span of 1 month. So let's try and dissect what to do in such kind of volatile times. Okay. Firstly, let's have a look at this chart. This is the dollar INR 24-hour offshore chart, and you can see this vertical rise from 85.50 beginning of July till about 87.50, a 2 rupee weakening in just about a month's time. So if you look at the technical indicators, it's very clearly that the prices have gone high, very high in fact, in a very short period of time, and the signals look dollar overbought. So there is a good chance that it might correct. So even if you look at the previous peaks here, it is very clear that we have reached a resistance zone. And another interesting thing is vertical rise and 2 days where the prices have stabilized. Okay, the prices have not gone higher again beyond that point. That indicates that this region is some kind of a resistance region. Okay, I'll want to show you another chart. Okay, here I'll try and zoom in a bit. Okay, so this is the dollar INR onshore chart. Okay, from 9 a.m. to 3:30 p.m. IST. So you will see a lot of gaps here and there. Let me try and zoom in and get your attention to a particular place here. Okay, so these are the price gaps that have formed, okay, very clearly, and what we have seen in history is these price gaps on the daily chart usually fills up. In fact, there was a price gap here as well and it filled up in one day. But what I wanted to show you is this particular candle here. Okay, that is the candle for today. Today the prices opened at much higher 87.60 levels, and then there was a decent plunge today in intraday time, and what we saw a level very close to below 87.25, and that was around 87.22, and then it went higher again to close at 87.54, 54 quarter. So what I want to show here is this kind of a candle in candlestick charting is called a kind of a hammer, where you have a smaller body and a very long lower shadow. Now what does that show? In this vertical rise, we have seen such a deep correction. There were rumors of RBI intervention, but the bottom line is prices did fall and that it rose again intraday. Okay. Now what does that all say? That says that probably price is reaching a peak, a short term peak, a resistance area, and it can decline. There is a possibility that it can decline. So what is our broad recommendation here? Okay, our broad recommendation here is that at the levels between any level above 87.50 or levels between 87.50 to 70, these are great levels for all dollar exporters to hedge. That is why hedge using forwards and options to all dollar exporters. To dollar importers, you can look to avail buyer's credit funding. You can look at any kind of import funding. There is no point paying at 87.50, 60 levels, very high prices, and as we know, whenever prices go up like this, there is a good chance of a corrective reaction. So all importers, whoever have payments due in the next 1 to 2 weeks, should to look to avail buyer's credit and look at any other kind of import funding options. Okay. This is what I am recommending to all dollar exporters. Levels are around 87.50, 60 spot levels, and you have a 1.5 to 2% forward premium, and these are the forward rates for these specific maturities. Okay. So you get levels of 88, 89 for a longer period. So these levels are extremely attractive to lock in your forward rates and to lock in really attractive profitability. Okay. Now another thing what I wanted to show was on the option side, because there might be a lot of market participants who are feeling that in a month rupee has weakened 2 rupees. Okay, so it can go to 89, it can go to 90, lot of nightmare starts happening. So you might want to have some degree of upside capture for exporters, and importers want to protect a maximum rate, but they might feel that if rupee recovers, I am able to participate in that kind of a favorable market movement. So a vanilla option is a very appropriate instrument for both exporters as well as importers. So what I have given here is, if you look at the forward rate, if I take vanilla option, with strike price close to the forward rate, which is for 1 month 87.66 half and for 2 months 87.77 half. If I take vanilla option at these strike prices, for 1 month I pay 47 paisa premium, option premium, and for 2 months I pay 65 paisa option premium. So if the markets are moving 2 rupees in 1 month, okay, so these option premiums are worthwhile to pay, because by paying 40-45 paisa you are able to capture unlimited upside, or an importer is able to capture unlimited downside. Okay, so options also come out to be very attractive in such volatile times. Okay, so that's the conclusion to all exporters. Please look to hedge using forwards and options. Importers can take buyer's credit and postpone their payment, and whenever rupee recovers, let's take it recovers to 86, 86.50, those levels you can look to hedge back your buyer's credit that you have taken at 87.50. Okay, so that is it from my side. For more insights on currency and forex markets, please scan this QR code and join our WhatsApp community.